You're good to go.
Right. All right, everybody. Welcome to today's webinar. It is December 1st already. Hard to believe. We got one more month left of 2023. Unbelievable. But it's been a very unusual year for the markets and the economy, and we're hoping 2024 is going to bring some fruitful returns, not only in the stock market but in the fixed income market. If you remember, a couple weeks ago, we talked about bonds and so how they're interest rate sensitive. And as interest rates come back down, the bond values are going to go up. And so that's going to be great. According to a few people I've talked to, we're thinking that the interest rates are going to become lowered perhaps in Q2 of 2024. And if not Q2 2024, at least we'll have the schedule for lowering them by that point. So lots of good stuff to look forward to on that in that aspect. But again, welcome. Coming at you live from Tampa, Florida. It's been a little bit cold recently, but got another warm day. So we're here to talk to you about asset allocation. And what does it mean? Pretty much the basis of all investment objective is asset allocation. How you achieve a certain outcome is determined by the allocation of those assets. And by allocation of those assets, I mean what sectors and what types of investments are you putting your money into, how much of each sector you should be exposed to, and how that's going to bring you to the, the goal, the objective. So with that said, if you have if you're maybe on the younger side and just kind of have a hodgepodge of equities, asset allocation can mean a few different, in a couple of different ways, meaning where you can have a diversified asset class, or you can diversify the sectors. It's a little bit broad. So if you're somebody who has an all equity portfolio, perhaps asset allocation for you would be how are which sectors of stocks do you have? So equities and stocks, as I mentioned when we had our equities webinar, are the same thing. So if you have all the different sectors, energy, healthcare, consumer cyclical, defensive, all that good stuff, how much of each one you're exposed to is considered part of your asset allocation. Now, for you as an individual, your entire financial portfolio could be that not only do you have this account or several accounts with your broker dealer, but you also have several investment properties. So real estate. So real estate is considered part of your overall portfolio. And if you are going to be very long term, that's something that you're going to be pretty exposed to is real estate. So let's say, for example, you're a very conservative investor. Okay. You're not sure kind of what to do. You go to someone like me. And for those of you who don't know what I do, I am an investment advisor with a major broker dealer. So I'll have someone come to me, hey, this is what I have. I'm a very conservative individual. I don't have the ability to take on a whole lot of risk. I have my timeline. I'm in retirement age. My time horizon is a little bit shorter. So what can you do for me? So with that, I will take a look at their asset allocation, what they're currently allocated in, and see if it matches what they're telling me their risk tolerance is. So I actually had this, no joke, had this today. Two different clients. They tell me that they're moderately, or one of them said that they're moderate in risk tolerance, and then the other one was rather conservative. The one who was moderate was all in fixed income. And the person who told me that they were conservative had a portion of their portfolio in equities, which equities, for the most part, if you're all in equities, it's considered aggressive because of the ability for it to go up and down. However, there are quite a few conservative ones that do well all year round, regardless of how the market's doing. So, for example, like Kimberly Clark is always going to be selling toilet paper, regardless of if we're in an inflationary economy or not. So, somebody who's going to be moderate, we should have a portion of their portfolio in equities and a portion in fixed income. Fixed income meaning bonds. Now, usually if you're moderate, you're balanced. Balance is 50-50, 50% in stocks, 50% in bonds. So using that, taking that, okay, you know what? You're over concentrated in fixed income according to what your risk tolerance is. We're going to make a meaningful outflow in a tax efficient way out of bonds and go into fixed income. Excellent. Okay, so now on the other side, you got somebody who does have a large portion of stocks when they tell me that they're conservative. So we're going to be making meaningful tax efficient outflows out of equities into bonds. So that's, in layman's term, what asset allocation is. Gets to be a little bit more complex than that. Now, let's say that you have a goal to retire. You're 40 years old and you have a goal to retire by the time you're 65. However, you're very conservative. Now, according to the expenses that you tell me, in addition to your income and what you have elsewhere, maybe you have in a couple of accounts other places, everything about your financial life, if we're going to be able to meet that retirement goal by 65, one, I can show how much money that you're going to need. A good financial advisor should be able to tell you how much money that you need in order to retire based on your wants, wishes, and needs and what you currently have. And if there is no way that we're going to be able to get to that retirement goal of 65 with the current standard of living, the way that it's currently invested, we need to go more aggressive. So we need to make adjustments to their portfolio, to their asset allocation, the way that their assets are allocated, in order to grow the accounts enough so that they can comfortably retire and then switch the asset allocation to income producing investments. Okay. So let's say somebody who is 40, same example, someone who's 40, they want to retire by the time that they're 65. We need to go a little bit more aggressive. We're going to be looking at growth stocks, Tesla, Amazon, stocks that have the ability to grow that don't necessarily give a dividend. Nvidia gives a small dividend, I think, off the top of my head. I don't know, but that's definitely a growth stock. ETFs. There's quite a few ETFs where you can grow the size of your account. Well, I'm sorry, let's take a step back. You can grow the size of your account not only with the actual price per share growing in value, but reinvesting your dividends for more shares, a dividend grower, right? So growing the size of your account through dividends. So finding stocks or ETFs that have a high dividend amount, reinvesting that for more shares over the next 25 years, your account's going to grow astronomically. Could double 3 or 4 times, maybe even 5. So we find that we're able to get you a 10% return over 25 years on average, while introducing more money into the account, while reinvesting your dividends within this asset allocation mix. We're going to be able to get you to your goal of whatever the amount is that you need for retirement. Okay. So that's excellent. And going back to what I was saying, just a real quick tidbit of information, little hot tip of the day. There is a company by the name of First Trust. They do ETFs. They have UITs, which is a unit investment trust. I don't do a whole lot of UITs, but ETFs are exchange traded funds. VOOs, the Vanguard S&P 500 ETF. SPY is the BlackRock Spider Shares ETF. So S&P 500 ETF. So First Trust, excellent company. They don't do a whole lot of advertising, which I like. And they put all that money that they would use towards advertising back into the company to make my experience as somebody who uses them even better. So this is not a paid ad. Absolutely not. That would never fly in this industry. I genuinely believe in their products and I utilize them heavily. If you are somebody who is a little bit more risk averse, you want the size of your account to grow, you should buy KNG, Kilo November Golf. It's the SIBO Vest Aristocrats dividend ETF, something like that. You're purchasing the S&P 500, right? So that's essentially what the underlying holdings are. It's the S&P 500. They have a mandate to achieve 8 percentage points higher than what the S&P 500 dividend yield is. Let's say the dividend yield of the S&P is 4%. Or, maybe I think it's a little bit more actually. I think it's closer to 5. So they have a mandate to achieve 8 percentage points higher than the S&P. And what they do is, in order to do it, they do covered call writing, which is a very conservative option strategy for achieving income. So you actually end up getting about 12.9% in dividends by purchasing KNG. We utilize that heavily for our clients with a moderate objective who want income or who have a moderate objective and want to grow the size of their account using dividends. It's an excellent tool for it. I highly recommend that you take a look at the ETF and see what you think about it. I think it's great. But we utilize that particular ETF as part of the asset allocation. Okay. So an asset class are ETFs, and we utilize them as part of the specific portfolio. So in terms of what is asset allocation, that's pretty much all that you need to know about it. But it's also important to have asset allocation benchmarks and to see kind of how you're doing in regards to, or see where you are at currently in regards to what you're invested in compared to what you say that your actual risk tolerance is, so that you can make changes if you need to. And what everything kind of comes down to is how well diversified you are. So if you are over concentrated in one asset class, whether it's real estate or if it's stocks or if it's bonds, it's going to throw everything off. Let's say the bond market crashes. I'm not saying it's going to. What if it does? You're over allocated in bonds. The size of your portfolio is going to plummet. Let's say that you're over concentrated in stocks. When the stock market collapses and you don't have the ability, the emotional wherewithal to weather the storm. Which, if you're going to invest in the stock market, you have to have the emotional wherewithal to weather the storm. It's so important. It's so important to be able to be diversified. Limits your exposure in certain asset classes. Let's say the real estate market were to crash. You only have a small portion of real estate. But the rest of your portfolio is stocks, ETFs, bonds, gold, anything else, whatever. Your overall portfolio is going to be very minimally impacted by that small exposure of real estate that you have. We keep it in there for when it is doing well. You're able to reap the benefits and the rewards of it. When it goes down, it's not all that big of a deal because it is a smaller portion of the overall portfolio of investments. So I hope that makes sense to you guys. It is important to make sure that you're properly allocated just for the reason that you want to limit your risk, limit your exposure to certain asset classes. So if you're somebody who's very risky, even if it doesn't seem very important, just take a look, see what sectors you're in. If you're all in energy and energy where oil prices were to plummet, I mean, that'd be terrible. You don't want to lose all that. There's so many other great stocks out there and great asset classes that you can invest in that'll help bring you to a very sound investment strategy. Okay. So that's pretty much it in regards to asset allocation. If you were to go to an advisor and ask them if they can take a look at what you're currently out, how you are currently allocated, and they say that they're not able to do that, I would find somebody else because it's part of what we do. It's a very important part of what we do. And also don't let them charge you for it because that should be part of their practice. Like some people charge $1,000 for a financial plan. I think that's silly. That's included in what our value proposition is for working with us. It doesn't need to be an extra expense. We'd have to do those in order to make informed decisions about how we're going to invest your money. So I think you just be careful is all. Don't let anybody take too much. Don't let anybody take too much money from you in terms of creating your financial plan. Also, make sure that anybody who's charging more than 1%, when you ask them what their fees are, if they're charging you more than 1%, I would be very curious as to why. 1% is really the industry standard. They must be going absolutely and completely above and beyond, which I mean, I think I go above and beyond for my clients, but to justify more than that is kind of crazy, I think. So don't let anybody charge you for an asset allocation proposal or a financial plan because that's just silly. Make sure that you are allocated properly depending on what your risk tolerance is. And make sure that you're well diversified. There's nothing wrong with being well diversified. You can take risks. If you're a risk taker, by all means, take a risk here and there. But make sure the core of your portfolio is very strong and spread across many different asset classes for the reason of, in case a portion of it goes, one of the asset classes were to fall apart temporarily, because like I said, everything's a business cycle. Real estate is a cycle. Bond market has a cycle. Stock market has a cycle. Everything will eventually come back. In the meantime, when a portion of your portfolio is down, you've got a rest of it that's doing very well. So I hope this was helpful. I hope this gives you a little bit more insight as to taking a deeper dive in, if you were to take a deeper dive into your portfolio, what you should be looking at if you're serious about making sure that it's soundly invested. So if you ever have any questions, feel free to reach out anytime on Instagram at the Wes Gottesman or on TradeZing at Wes. Keep in mind, we do have a audio room that I host daily, Monday through Friday, 4 p.m. Eastern Standard Time after market close, where I give a daily recap as to what happened that day, what happened in the day before and extended hours, and what we can expect to see over the next couple weeks, and any other meaningful news that I think would help make a decision on any kind of investing that you do, as well as hot tips of the day. You got that hot tip today, just to reiterate, KNG, Kilo November Golf. Check it out, everybody. We will be back with another webinar December 15th, 2 p.m. Eastern Standard Time. That one is going to be very interesting. It's all about private placements and sophisticated investments. I would tell you more now, but that would that'd take away from the next webinar. Hope everyone has a safe weekend, and we'll see you next time. Tune in for the Trading Audio Rooms, 4 p.m. Eastern Standard Time, Monday through Friday. Peace.